In day trading, the quest is to find a trend early and ride along with it. There are many trend indicators available. However, many traders say that by the time they recognize or define a trend, it's almost over. In my opinion, there's not sufficient interest paid to cycles, as cycles are a way to get into trends early. Equities all move in four ways. They cycle, they trend, they cycle within a trend, and they consolidate. Equities certainly trend more than they cycle, but that does not make cycles any less important. A way to get into a trend early is to always trade in the direction of the cycle. Remember, a cycle oscillator is a leading indicator. Trends are almost always preceded by a cycle in the direction of the trend. If the equity is cycling, you just trade the cycle. If it begins to trend, you ignore the cycle and stay in your position while the trend continues, using a trend indicator. Remember, the trend is stronger than the cycle, and the equity will often cycle within the trend. At that time, the trend indicator becomes primary, and the cycle is secondary. In using cycle oscillators like the stochastic, for instance, an arbitrary length is used, often 14. Remember, cycles are measured from top to top or bottom to bottom. The dominant cycle may happen to be 14, but it does you no good for trading purposes. To trade a cycle, you need to take 1/2 of the dominant cycle length, which would then measure the cycle from top to bottom and bottom to top. And that's how you trade cycles. Here's a screenshot of COMEX gold futures, and this is the cycle oscillator here, and I have a utility that determines dominant cycle length, and in this case the dominant cycle length was 18, and so I take half of that number to measure cycles from top to bottom. I input that into the cycle indicator, and you can see right here the COMEX futures are cycling. So it gets in very early right here before this moves up, crosses below the overbought line right here, and right at the very beginning of this down cycle. Then it cycles down here, then it makes another up move right here very early, and in this case it goes up to this point, which is a higher high between here and here, and then pulls back here to a higher low between here and here. So this is the beginning of an uptrend. And so ordinarily I would get out of this trade right here and get back in it again right here when the cycle starts up. Right here when it crosses this oversold line right here, you get in about here, and then you get out around here. Or if you recognize this as an uptrend, higher highs and higher lows, you use the trend indicator here, which stays above the zero line and shows this trend continuing on through here. Right up here you can see the swing cycle moves down here in a failed down cycle right here, and then a failed up cycle. And when you have a failed cycle like that, generally there's a pretty good move in the opposite direction. So the failed up cycle is followed by this down move here, and you can see the trend indicator moves below the zero line right here, so you know that the uptrend is coming to an end right in here.